Hi students, let's revise CA Final AFM Chapter 3 Advanced Capital Budgeting Decisions Illustration 12. So let's go through the question once. A company named Robbie Cube decided to replace the existing computer system of their organization. Original cost is 25,000 and it was installed 5 years ago. Current market value of the old system is 5,000. Depreciation of the old system was charged with the life of 10 years with estimated salvage value as nil. Since the old machinery was installed 5 years ago, so and current market value of the old system is also 5,000, we have to calculate the carrying amount as on the date of replacement. So 25,000 minus salvage value is nil divided by 10, so we'll get around 2,500 into 5, which will get 12,500. So 25,000 minus 12,500, so the carrying value will be 12,500. Okay, going up next, depreciation of the new system will be charged with life over 5 years. Present cost of the new system is 50,000, salvage value is 1,000. So 50,000 minus 1,000 divided by 5, we will get the depreciation. Here they have given estimated cost savings with the new system is 5,000 per year. They have not given what will be the actual cost for running the new system. They have given cost savings. So if we replace, how much will be the savings? That they have given 5,000 per year. So we have to follow incremental NPV approach, and if the incremental NPV is positive, then we can go ahead of replacing the computer system. If it is negative, then we should not replace, we should continue with the existing system. That will be the rule. Now increase in sales with new system is assumed 10% per year based on the original total sales of 10 lakh. Now okay, then company follows a straight line method of depreciation. Cost of capital is 10%, whereas tax rate is 30%. Going into the answer, the initial cash outflow, the cost of the new system will be 50,000, which will be the first cash outflow, and then there will be a cash inflow of 5,000, which is nothing but the sale of old asset, which we are selling for 5,000, and there will be a tax savings, tax benefit. Actually this is not payable, it's tax savings. So how will we get this tax savings? So the old machinery cost is around 25,000, and after depreciation of 5 years 12,500. The value of old machinery as on replacement date is 12,500, and we sold it for 5,000. So we are getting a loss of 7,500, wherein the loss, we are getting a tax benefit of 30%. As the tax rate is 30%, we are getting a benefit of 2,250. If this loss didn't happen, then we have to pay a tax of 2,250. So this opportunity cost is considered as a cash inflow. So 50,000 cash outflow, then savings like sale of old asset, then plus tax savings, the ultimate net cash outflow will be 42,750. Then going further, in between cash flows, here there is a either it is an error, because they have given increase in sales with the new system is assumed 10% per year based on original tax sales of 10 lakh. But if you take the solution, they have considered 1 lakh into 10%, which seems wrong. So we are going with the ICAI approach only, but actually it is wrong, because 10 lakh into 10%, 1 lakh we should consider ideally as our incremental sales, then 1 lakh plus 5,000, that's how we should have calculated. But ICAI is taking 1 lakh, which obviously is wrong, some printing mistake or something, I don't know, which we have to check either in our RTPs or latest releases or student journal. So now going with the ICAI answer, so ideally instead of this 10 lakh it should have been 1 lakh, or instead of 10% it should have been 1%. So I think 1 lakh will be a more correct amount. So 1 lakh into 10 percentage, 10,000, then cost saving of 5,000, then additional depreciation we have to reduce from this incremental contribution. uh, 7,300 will be the additional depreciation, then 7,700 will be before taxes, then taxes of 30 percentage. So incremental profit after taxes 5,390. And if we add back depreciation, since it is a non-cash item, then we'll get an incremental cash flow of 12,690. Then since they have given 10 percentage as the cost of capital, then present value annuity factor at 10 percentage will be for 5 years it will be 3.791. Multiplying that we are getting 48,105. Then salvage value also, there is an change of 1,000 because previously there is the salvage value is nil, now it is 1,000 into 50 year present value cash flow, which is 0.621, we are getting 621. Then incremental NPV will be initial cash outflow of 42750 plus 48105 of in between incremental present value cash flows plus salvage value of 621. We are getting a value of 5976, and in our material also 5973, rounding of error. So the incremental NPV is positive, therefore company should go ahead and replace the machinery. Thank you.